I'm Cara Fraver. I'm the Business Services Director for the National Young Farmers Coalition, and I'm making this little web video to talk a little bit about crop insurance options for beginning and diversified farmers, specifically about whole farm revenue protection, which is a new kind of crop insurance. We at National Young Farmers Coalition are on a grant with Cornell University, with a team at Cornell University, and that team involves this aganalytics.org team, which is a team that's making a really cool web tool. And the whole grant is funded by the Risk Management Agency, which is part of the USDA. So again, I'm Cara Fraver from the National Young Farmers Coalition, and here we go. So this is a quick overview of how crop insurance works. Some beginning questions might be, what's the deal with crop insurance? How does it work? How does it work for beginning farmers? How much does it cost? Does it make sense? How do you sign up? Crop insurance is not something that tends to be historically used by the sort of diverse young farmer group that the National Young Farmers Coalition works with, but we are here to talk to you a little bit about it because we think there's some really good opportunities that could be beneficial for diverse beginning farmers. So this is a New York crop insurance and risk management project that is part of the Risk Management Agency's Targeted States program. So that program identifies states that have really low crop insurance participation and does some specific outreach to try to up crop insurance rates. This year, the New York program is based at Cornell for the first time. In addition to doing outreach like this webinar or little video, Cornell has also developed this really cool web tool that helps farmers kind of weigh the options with crop insurance and get a better understanding of how it works. And so we'll talk a little bit about that web tool here in a minute. I'm trying to go pretty quickly because I want this to be easy to listen to and understand. So what's the story with crop insurance? As you know, if you're watching this, the agricultural economy is volatile and prone to natural disasters. And crop insurance is a safety net to protect farm revenue and farm yields from that kind of danger. And whole farm revenue protection is this new crop insurance option that's intended to kind of level the playing field by making that safety net available to smaller and diversified growers. They historically haven't been super well served by crop insurance. So how does crop insurance work? You know about other types of insurance because you drive vehicles. So like car insurance, you pay a premium to buy a policy. With car insurance, you pay that premium, say, every month or every 6 months. With crop insurance, it's an annual premium usually. And then if something bad happens, you file a claim with your insurance company, and they look into that claim. And then if they agree with your issue, they pay you an indemnity payment. While premium and claim are words we are really comfortable with, indemnity payment is not something we use in our everyday speak, but that's what you get paid out in order to make you whole. How does crop insurance work? We're going to be talking specifically about whole farm revenue protection here. So unlike some other crop insurances that are based on yield, this is based on revenue. Right there in the name, it says it, whole farm revenue protection. And so it's ensuring that your farm will earn a certain amount of revenue in that year. So it's covering the income that you're expecting to make off of selling your crop. So it's not liability insurance, like the liability insurance you might carry at your farm in case somebody like slips and breaks an ankle and decides to sue you. It's not property insurance, like the kind of insurance that you carry to replace damaged things like a vehicle or a home or something like that. With whole farm revenue insurance, you ensure that your farm will make a certain amount of total projected revenue. If something happens outside of your control, say a drought or a tornado or weather or pests or even market prices, prevent you from earning that income, that revenue, making that revenue, you can file a claim with your risk management agency. And then you get this indemnity payment to make up the lost revenue. So it's kind of, you're insuring to a certain level of revenue, and that indemnity fills up to that level. We'll talk a little bit about that a little bit more when we get into the tool. So, to just chat about the numbers for a second, it's 80% of the premium cost. That 80% of the premium cost is subsidized, paid for by the government. So, in order to make crop insurance affordable for all kinds of farmers, they understand that they need to subsidize it, and so at most coverage levels, a huge amount of the premium cost is subsidized. The higher your coverage level, the lower the percentage of of subsidy you could get. So if you really want to have like 100% of your revenue insured, they're not going to cover 80% of that. But and then the more diversified your farm is, gets you a higher level of coverage. So if you produce 3 or more commodities, you can insure up to 85% of your revenue. Let me see if there's anything I could say about that to make that a little bit clearer, right? So because you're a more diversified farm, you're a less risky farm. And so therefore, they're going to insure a higher level of your revenue, a higher percentage of your revenue. And whole farm revenue insurance will cover up to $8.5 million in revenue. We don't have a lot of beginning farmers that are making $8.5 million in revenue, but in case you are, that is the maximum level of coverage. So does it work? Does whole farm revenue work differently for new farmers? Yes, indeed. Beginning farmers can get special benefits. So usually, farmers are required to show 5 years of tax records to prove their historic revenue, right? Because obviously you can't just say, I expect to make $100,000 this year, and they'll say, great, we'll cover you for $100,000. You have to show that you have indeed made money in the past that corresponds to the amount of revenue you're hoping to cover for this year. However, because beginning farmers don't always have 5 years of tax records, you can use 3 years of tax records. And then in some cases, they will take records from other operations that you've managed, perhaps not on this ground, but in another area. Maybe you helped to manage a farm and you're running a farm that's very, very similar to the farm that you managed. You may be able to use those records to show your projected revenue. You may be able to use records from a farm that is on the property that you are now planning to farm, but was not under your management. Again, those are just some ways that they're trying to be flexible to get more new farmers involved in this program. Beginning farmers also have an extra 10% premium subsidy. So the government coughs up a little bit extra for beginning farmers. And for the risk management agency, the agency that oversees crop insurance, a beginning farmer is someone with 5 or fewer years of an insurable interest in a farming operation. Insurable interest means that you were enough of a manager that you could have gotten insurance on that farm. You weren't just a helper, but you were a co-owner. You were an insurable interest. So 5 or fewer years of being an insurable interest in a farming operation. And that's a little bit different from other USDA programs. Some of those consider a beginning farmer anyone with 10 or fewer years of experience. So that's just an area of difference to point out. You might be a beginning farmer with FSA, but maybe not with risk management agency. So how much does whole farm revenue insurance cost? That depends on your historical revenue. It depends on how much you're projecting to make this year. It depends on what crops you grow, how risky they are, and also how diverse the farm is. So also how risky you are. So if you grow a large variety of crops and have more diversification, you are a less risky farmer. And if you're growing irrigated crops, you're a less risky farmer. And your cost depends on whether you're a beginning farmer, because as we just talked about, beginning farmer subsidies are extra subsidized. Beginning farmers are extra subsidized by the government. So let's talk a little bit about the web tool. I'm going to get to that in a second, and we'll go through the tool, and that gives us a clear picture of what it costs. So does whole farm revenue make sense for you? That's not for me to tell you. That's for you to decide on your own. And we've gone through this tool with some beginning farmers to really try to understand how well whole farm revenue is working for them, and it really comes down to a little bit of an emotional question, like how risk averse are you? How risky is the crop that you're growing? Is that risk high enough that you think it's reasonable to justify the cost of insurance? Is it worth it to you to put some money up front in order to guarantee your income? Do you have money to put up front to guarantee your income? One of the statistics that makes it seem really great is that in 2015, for every $1 that New York producers spent on whole farm revenue crop insurance, they received $3.76 in indemnity payments. Right, so that's pretty awesome, right? Every dollar you spent, you got back $2.76 more, and that's partially due to the subsidies. So that's shows a little bit of what kind of payback farmers are getting. So how do you sign up? To sign up for any crop insurance, you go through RMA to find an agent or to find a list of agents, but you don't sign up with the risk management agency. You sign up with an independent crop insurance agent. So you can find a list of them at this link right here. This program is really new, and it's not been heavily used in New York State, and so it's very likely that your crop insurance agent doesn't have a huge amount of experience with whole farm revenue insurance. So bring all your paperwork, bring any estimates that this online tool has helped provide for you, and go in with lots of patience and willingness to kind of talk through it with your crop insurance agent. At Cornell, the team that we're working with at Cornell is really working to understand who has sold whole farm revenue insurance policies in New York State, so what agents have great experience with it, so that we can maybe help point beginning farmers and other farmers to those agents in particular that have a little bit more experience with it. So contact us if you're interested, especially contact us if you're having any trouble. The sign up for this deadline is March 15th, so it's coming up really soon, which is why I'm trying to get this online right now. And then for other crop insurance information, testimonials, and other tools, specifically the tool we're going to look at right now, check out this Ag Analytics webpage. Ag Analytics is our team at Cornell, and they've worked on this tool, and this tool is really cool. This tool works around the country. My understanding is that it works around the country. So even if you are not a New York State farmer, this tool could really still help you understand. So we're going to look at these Ag Analytics options. So when you go to the website that we just looked at on PowerPoint, this is what it'll look like. And you'll click here on Farmers, because that's what you are, presumably. I am logged in here. That is helpful. So you can create a screen name and log in. And here there's a single crop premium quoter, which is for a more traditional crop insurance. And then there's this whole farm premium quoter. That's what you want. You go there. There's lots of text here. I won't read it to you, but this is a great introduction to understanding some stuff about whole farm revenue that we've just talked about. And this is a materials checklist. So this is not a small task to enter in all of your data. You may not have great historical revenue data, the kind of stuff that you're going to need in order to fill this out. I mean, as the business services director, I encourage you to keep it. I think it's really nice to know exactly where you earn your money on your farm. And you kind of have to know that in order to use this tool. So I'm going to go ahead and assume that you do track exactly where you earn your money on your farm through exactly which crops. And I will show you why that's important here. So you go to your state. I'm going to say New York, but look, you could do this in any state. This crop insurance is national. You go to your county. I'm going to choose Washington. That's a county which is near and dear to my heart. You're going to choose your commodity year, 2017, and then how you file your taxes. I think lots of people file for calendar years. Did you buy other federal crop insurance? No. Are you a beginning farmer? Yes. And then you enter your historical revenue. So this is basically from your Schedule F. However, it's the revenue for your farm. You can understand more about it here. But if, for instance, you earned extra money doing some custom work for someone or making jam that you sold as an added value product, those things don't really count towards this revenue. The jam's a little more complicated, but the custom work, off-farm consulting, that sort of thing, that's not going to count towards the revenue you earn on crops. So this is just the crop revenue. There's more about that. Of course, it's like a little specifics. But so I have just pretty much made up numbers here. I don't have numbers for a farm, but this is, I think, kind of reasonable for, let's imagine we're looking at a diverse vegetable farm that is only vegetables, lots of fresh markets, some CSA. So say they started in 2013, this is their growth pattern, growing steadily but not outrageously, and then for this year, 2017, I have imagined a projected income of, I think, $173,750. So that is broken up by commodity. Strangely, there's not like a box to put that in, but your projected income for this year. But that's what this expected revenue should total. So because this website is under construction and is often updated, sometimes you will find that when you go under covered commodities, that there are tons of covered commodities, which is the case this morning. There are all kinds of things, asparagus and beets. Sometimes the list is a lot smaller. I'm not exactly sure about that. It's better if the list is really long because you have fewer items that go into the category called other, like other vegetables. And that improves the level of diversification that you can show. So we were lucky to have lots of different covered commodity options this morning. And then you would just be basically looking at your projected income per crop for this year and entering in the total value here. So I went through all of these crops, many of them, and imagined how much I anticipated this imaginary farm would be making in a year. Your numbers would probably look more like 3,783 than $4,000 because round numbers don't actually happen a whole lot in real life, but for the sake of math, we did it like that. And you'll see, like I said, this list has a lot of different things on it this morning, but then there will be categories like greens, other. You will want to show a category for all of the income that you expect to earn growing crops on here. So if you have something like arugula that's not on the list, it needs to go into another category, greens, other. There's also just other vegetables, irrigated. Strangely, this morning there's not a regular fresh market tomato option, but there is. Charted my tomatoes. That probably wouldn't work, but your crop insurance agent would be able to help you with that. So this is a long and tedious process to enter in all these numbers, corresponding with numbers on your farm planning spreadsheets. But once you have done that, you can go down and say calculate premium. And this will say that I have 21 eligible commodities. And that is showing a very high level of diversification, which is making my farm seem like a pretty safe option for the risk management agency. Like, I look really diversified, and so they're less likely to lose a lot of money on me. So then you can go down here and you can see that this helps you understand your premium options. So if you want to be covered at 50%, which I'm going to get out my calculator and say that my farm, that 50% of the income for this farm would be about $86,000. So if I were covered at this very base amount, if I earned less than $86,875 in my year, say I earned $76,875, I would get $10,000 back. So that's what the 50% subsidy means. And that would cost me, that my premium for that year would be $186. So then you can see, if I go over here, $186, that's not very much money. If I go over here to the 75% option, that makes my premium $510. And that coverage would be for $130,000 about. So on this mythical farm where I'm earning about $173,000, if I were to make less than $130,000-ish, I would get reimbursed for my loss. I would have an indemnity payment for my loss. And that would be, so say there was a big drought, I only was able to sell $100,000 worth of vegetables at this level, I would then get a check for about $30,000. So that's kind of how it works. You can see that there's a very standard curve that goes whoop way up to a much higher premium for a much higher level of coverage. So this is kind of where farmers have lots of questions, like, do I go for the 75% coverage and a more reasonable premium? Do I go for a much higher premium, but also a level of coverage that is much more likely to end up with a payout? Those are questions for your business to ask. So this is a lot of what you're going to be looking at. You can look at it in table form if that is how your brain works. And just to feel better about your life, you can look at the subsidized premium, and you can see that if you remember at the 50% level, we were paying $186, but the total cost, which is what you and the government would be paying, is $1,862. So you can see that it's a very heavily subsidized program. And then you can look here for liabilities, subsidy, and other data. This liability one is a really great way to see what your coverage levels are. I'm a little confused about those numbers, but that's kind of the basics of how it works. You can definitely contact me at Cara@youngfarmers.org if you have questions about it. I can kind of help you walk through the tool a little bit. You can contact Ariana at Cornell or Jenny Ift at Cornell if you have questions about the tool. Don't know that there's a whole lot more I have to say about it. It takes a lot of time to put all those numbers in, but it's a really amazing thing to be able to calculate your premium specifically. And it takes into account your beginning farmer status. So hopefully that will make it much clearer how whole farm revenue insurance works. Again, how you sign up is to go to this website and look for an agent in your area. And this is the website, and the deadline is March 15th. This is the website for the online tool. And this is information about Cornell University. This is Jenny Ift's contact information, and my contact information is Cara@youngfarmers.org. Great, thanks so much, and thanks for watching this.